Central banks across Africa grapple with the delicate balancing act of taming inflation while supporting economic growth. Financial analysts and economists are actually closely watching for indicators that might shape upcoming decisions. Today, we dive into the critical monetary policy decisions shaping the economic landscapes of Nigeria, Ghana, and Kenya, pivotal countries, I must say, as we anticipate the upcoming MPC meetings in these countries. We will examine the factors influencing interest rate decisions, the potential impact on inflation, exchange rates, and overall economic growth. This morning, I have Dumebi Oluwole, a senior economist at Stears, to help us unpack this. Thank you so much for joining us.
Thank you for having me. Good morning.
And just as I said, inflationary pressures are packing up steam on these three countries that are pivotal in the African economy. And of course, the economy is not still looking good for them, most especially for Nigeria and Kenya. So what are your expectations regarding the monetary policy rate, knowing fully well that the MPC would be meeting very soon across Nigeria, Ghana, and Kenya?
Yeah, so I'll start with Kenya. So primarily Kenya's MPC meeting is in August. So that's why I'm starting with them first. The outlook there is pretty slim for now. So primarily we're looking at a country that is coming out of or still, facing a lot of fiscal pressures and fiscal issues. There was a protest in Kenya just a few weeks ago, and we're also seeing bearish investor sentiments towards the Kenyan economy right now. And this is coming off of the back of, an economy that we're already seeing stellar growth. I mean, as of Q4 2023, the Kenyan economy grew by above, 5%. And even though the IMF is still projecting that growth will remain at least by 5% average, which is also in line with what we're expecting for the economy, chances are that the central bank will actually maintain its high interest rate environment just to, somewhat positively anchor inflation and exchange rate expectations. So that's for Kenya at the moment. But weeks leading up to August, when they would have their meeting, which will be around the first week of August, we will definitely have additional updates and additional considerations for what the Central Bank of Kenya will be looking out for before making their decision known to the general public. Then moving to Ghana, Ghana has also made a lot of headlines from their debt restructuring agreement, successful debt restructuring agreement conversations with bilateral creditors and international commercial creditors as well. So with those positive moves on debt restructuring talks, we're seeing that the IMF is ready to give Kenya some additional funding, think of about $360 million, and this will somewhat ease the fiscal pressures that Kenya is currently facing. Even though the credit outlook, sovereign credit ratings for Kenya is still quite bearish, the expectations are that with this additional funding that the Ghanaian government will receive from the IMF, we'll definitely see some supportive measures towards, allowing the inflation rate ease even further. We've seen favorable base effects support Kenya's inflation, and we do expect that trend to continue. However, on the exchange rate side, we've seen some pressures, but still, and in that regard, we do expect the Bank of Ghana to maintain its interest rate at around 29%. Again, their meeting is going to be this Friday. So when we hear the outcome, we'll definitely know what the Bank of Ghana has also considered, and if they decide to take a decision to cut rates, it's still not far-fetched, and that will definitely be hinged on the additional funding that they're getting from the IMF. But our forecast is that they hold. Now, the spotlight really is on Nigeria. Simply because of all the many market indicators that we've seen in the past few weeks. From the end from May up until now, we've seen significant shifts in the economy, starting with, inflation. We saw the latest inflation rate inch up even further to around 34.19%. It is still steadying at a 28-year high, and it is the 18th consecutive monthly increase since January 2023. But more importantly is the month-on-month inflation rate. You see that the month-on-month inflation, after slowing for about 3 months, picked up again in June 2024. But however, when you dissect the inflation numbers a bit more, you will see that the rate of increase in inflation is actually slowing down. From February 2024 to January 2023, we've seen a decline of we've seen a decline from about 1.8 percentage points to 0.2 percentage points. And this is even happening despite the fact that June inflation numbers, increased. So what this points to is that we're seeing an impact of the interest rate hikes on inflation rate. And going further into the year, we will see other supporting measures to further taper the headline inflation rate. Primarily, we're looking at base effect. Coming from last year, July, August, and even September, we definitely saw higher inflation rates, and this will support the decline in inflation rates this year within that period, within this Q3. So what this means that the headline inflation rate will, somewhat decline. Then also we're seeing, we also know that the harvest season is also going to be this quarter. So we do expect that to have a positive impact on inflation rate as well. Then we also have the fact that the federal government, yes, is trying to, somewhat support to ease price pressures. Actually, they've given an import and subsidy. Yes, please go ahead.
Well, I just wanted to get your reaction as per the analysis you've given, if that also speaks to the 60% probability for a hold or 40% for a hike, and what the base scenarios would be.
Yes, so that's where I was actually leading up to. Thank you for raising that. So with the inflation rate, the analysis I've given so far does support a hold decision, right, for the central bank, simply because price pressures are expected to abate even further. Then you look at the other consideration for the central bank, and that will be exchange rates and exchange rate expectations. Even though we've seen a lot of price pressures or currency pressures rather on the exchange rate, the naira, at least at the parallel market last week, touched about 1,600, even higher, right? So trying to anchor exchange rate expectations even further, we could see that definitely supports the 30% probability for the central bank to hike rates within 25 to 100 basis points. But to counter that, you also need to consider the fact that the global interest rate environment is beginning to look like it's going to cool earlier than even planned, right? So because interest rates globally might start declining soon, the central bank might want to take up that bet, to say, okay, let us pause now because our rates are still very favorable to investors that will be ramping up their appetite towards, emerging and developing markets. So even though the exchange rate pressures, push for the CBN to actually hike even further, the fact that interest rates are higher compared to what's attainable globally, the CBN might still decide to hold. Then the final consideration is output levels. Lending rates have increased significantly, and the central bank would definitely want to somewhat support output from businesses. We've seen SMEs shut down. We've seen even top business owners, complaining about the fact that their ability to expand and access credit is thinned out because of how high interest rates are. So to allow this, to reduce the impact of this on output growth, the CBN might again pause. So that's why we have that probability split: 60% for a hold and 30% and 40% rather for a hike, between 25 to 100 basis points. Yes.
Okay, of course, we know that the MPC meeting is not all about interest rates. So do you also see other tools like maybe the asymmetric monetary policy corridor, the cash reserve ratio, and probably the liquidity ratio staying the same too?
To be very honest, I do. But then again, like I said, there's still room for the CBN to make some of these adjustments. We do not expect that they would increase the CRR again, simply because, banks are already, feeling the pinch right now. To an extent, if you go to the bank, there are some banks that will not even allow you withdraw more than 20,000 naira cash, simply because they are trying to maintain, a deposit level that is substantial to them. So we do not see the CBN increasing the CRR again. However, what we do expect, the overarching theme here is that while the overarching thing here is that the CBN would definitely try to ensure that it balances out its monetary policy adjustments, right? To ensure that while interest rates are still high, to ensure that interest rates are high enough to keep attracting, investment inflows and stable enough that output growth does not fall, right? So that's what we do. That's what we expect the CBN to actually accomplish at this July meeting. And that's why the probability for them to hold is higher than that of a hike right now.
Okay, so let's go back to Ghana. It seems that the IMF loan actually did wonders for that country, and there's a bit of uptake in terms of economic value coming to that country now with the way the restructuring talks have gone and how they've been able to manage that. But then, of course, that would also mean that the MPC might not be so confused when it comes to taking decisions as regards the rates. Of course, it held the rates at 29% in its last meeting, and we are anticipating that the MPC would release a press release by Monday, 29. So what are your expectations if we were to look at what it is that we are to expect from them?
I mean, the growth prospects for Ghana right now they're quite low compared to what Ghana has achieved about some 5, even 10 years ago, right? But that is obviously coming up of the back of, fiscal irresponsibility. We've also seen high debt levels from them. But we consider the fact that this IMF funding is definitely going to keep doing a lot more good for Ghana right now, and that would support output growth. But if you look at the June inflation numbers that, was released by Ghana, even though the headline inflation rate declined, we still saw some level of persistent inflation risks with the monthly inflation numbers, right? And the expectation is that the MPC would want to, number one, positively anchor inflation and exchange rate expectations. And also, they will want to ensure that inflation risks are checkmated so that prices do not start rising again. And that's why our outlook for a hold, again, on interest rates still remains, right? So T-bill yields in Ghana are very favorable. We're seeing positive, responses from investors towards the Ghanaian economy. And we do expect that trend to continue. But regardless of that, because inflation risks are still very potent, the Bank of Ghana might decide to just take a hold on interest rates right now. And possibly, if the disinflationary trend persists beyond favorable base effect, we might see them decide to cut again at their September meeting.
Okay, you actually gave an overview of what might obtain in Kenya a while ago, and the shilling has been one of the best performing currencies in the world in the year to date, according to analysts. So how instrumental would this be in the country's monetary policy decisions?
I mean, it's very instrumental simply because the Central Bank of Kenya, we've seen them adopt Taylor rule effectively. What is Taylor rule? So Taylor rule basically is like a guiding principle for central banks that ensures that while they're adjusting their monetary policy parameters, specifically interest rates, they ensure that they balance it out with ensuring that output growth remains positive and even increases, right? So we've seen the Central Bank of Kenya adopt Taylor rule effectively. We've also seen the Central Bank of Kenya adopt forward guidance to ensure that they are actively anticipating inflationary risks and ensuring that they hedge against them effectively. So because of that, and because of the huge shock to the economy due to the recent protests coming off from the controversial 2024 finance bill, that has significantly impacted growth, and it has also dented exchange rates and inflation expectations, those two things that the Central Bank of Kenya will want to positively anchor. And in the light of that, because they also might anticipate slower growth, evidenced in their purchasing managers index for the month of July, which will be released soon, we do expect that they will hold rates again. There were already talks that the Central Bank of Kenya might actually cut rates at their upcoming meeting in August. Okay. But nobody anticipated the protests and the impact on businesses that happened, and the impact on businesses and investor sentiments that happened a few weeks ago.
Okay, so if you're going to give your final thoughts on what would obtain in Nigeria, we know that the MPC meeting starts today and ends tomorrow, and seems that the inflationary figures will not be going, in terms of its rise now, will not be going anytime soon, though we've seen a little bit of adjustment in terms of a drop. But then what should we expect rising from the MPC meeting between today and tomorrow?
We definitely would expect the CBN to consider everything I've mentioned here: inflation expectations, output growth, exchange rate, and exchange rate expectations. Their overall goal definitely would be to ensure that they help stabilize prices and ensure that output growth does not decline even further beyond what we currently are experiencing, because growth is already very sluggish. They will want to support output growth and ensure that, you know, inflation also declines substantially towards their target of around 21.4% by year end. But primarily, we also need to remember and remind ourselves that inflation in Nigeria is primarily driven by structural issues that definitely sit within the purview of fiscal authorities. And interest rates increasing substantially is not a one-time fix, you know, for solving Nigeria's inflation woes. So what this means is that the fiscal authorities, despite the measures that they're already putting in place, they really need to do a lot more in terms of addressing issues that are impeding Nigeria's agricultural productivity so that food prices can significantly decline. And then we'll definitely see inflationary pressures decline even further.
Of course.
So yes, that's primarily what the CBN will consider.
Yes, of course. That's what a few analysts have also said, that flying with monetary policy is more or less like a bird flying with just a wing, and it has to be a balanced mix between fiscal policies and monetary policies. Let's hope that the Nigerian government will be able to get it right with that. Dumebi Oluwole, economist at Stears, thank you so much for dissecting this and helping us to understand it better.
Thank you for having me.